This is Matt Godleski at CapTrust Advisors bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. U.S. equity markets move marginally higher while Chinese tech stocks fall, as inflation data continues to rise and earnings live up to expectations, but volatility is elevated. Markets moved higher this week on strong earnings reports as some of the largest global firms reported. Tech shares rose as the mega-cap names showed remarkable revenue and profit growth from last quarter and provided positive guidance looking forward. GDP growth missed estimates by a large margin, though still showed the highest reading since 2000. Jobless claims actually rose at the margin. Moves taken by the Chinese regime in recent months appears to be reinforcing the trend of becoming ever more authoritarian. The government there has taken aggressive action to clamp down on firms it believes are too powerful and that could influence policies deemed matters of the state. Markets there were rattled, wiping out gains for the year for most stocks. Sentiment in markets have been ambivalent lately, with concerns of runaway inflation one week followed by the prospect of deflation the next. In a surprise move, bond markets have continued to rally, appearing to ignore strong employment and inflation data and appear concerned more about recent Delta variant developments. Inflation-adjusted yields have dropped back toward historic lows. Equity market volatility has also picked up, with large sectoral shifts based on incoming data. We believe swings such as these will be the norm, with a wide range of potential outcomes during this unprecedented transition period. We remain convinced the economic restart remains the primary focus for markets, and it's too soon to determine whether new virus strains will affect the trajectory. Increasing COVID-19 cases are unsurprising given the reopening and the spread of the Delta variant, but vaccines continue to provide an effective buffer to outright lockdowns in our view. Cases in Europe have worsened and continue to dampen the prospects there, while emerging markets face significant hurdles ahead in getting the virus under control. Central banks appear resolute in their policy of overshooting past inflation targets to ramp up employment and make up for past inflation misses. Many now believe that rate hikes for the current expansion will be half what was expected a few months back, signaling the Fed's willingness to let the economy run hot. At the present time, we have made some small changes to underlying models to reflect the ever-evolving economic landscape. Additionally, upticks in volatility are creating opportunities here and there to adjust exposures. We are about halfway through earnings season, and concerns that the economy has peaked appears to be overblown. Analysts are revising up their forward estimates for most companies. The biggest risk to the outlook stems not from Federal Reserve policy or a growth scare, but from the potential for higher costs to reduce margins and eat into profits. Of course, the Delta variant remains a big unknown and could derail or delay further economic activity. Markets may overreact to economic data and other news with less trading activity in the summer, amid a wide range of macro outcomes. As always, we remain focused on unfolding market dynamics and make changes only when appropriate. Thanks for watching.